Good morning.
Hi, James. How are you?
I'm all right, thank you. Thanks so much for doing this. I can never remember what time it is in Singapore, but I think it's sort of late, isn't it?
Getting there. It's yeah, I think we're 7 hours ahead, so
Okay.
20 past 6.
Fair enough. All right, well, we won't keep you too long. So, usual kind of format. If I could get you just to sort of describe what the fund's trying to do to start off with, please, and then we'll go from there.
Yeah, sure. So I'll just give you a sort of high-level introduction to the trust. So Aberdeen New Dawn is an Asia Pacific ex-Japan equity trust. So excluding Japan, but it includes Australia and New Zealand, which makes it a bit different from some of its peer group. It's managed to a long-term quality process, so it's neither growth nor value in style, but the emphasis is squarely on quality. And the stocks are selected from the bottom up rather than sort of allocated top down. And that stock selections based on our own first-hand in-house research. What do I mean by quality? And I guess everyone defines it differently, but really what we're looking for is companies with strong and sustainable competitive positions, typically in industries that have attractive competitive dynamics and structures, companies with great management teams, healthy balance sheets, strong cash generation, and also first-rate ESG credentials. So in essence, what we're trying to do is find long-term compounders in the region that, provided you're kind of sensible on valuations, will give you both downside protection in sort of challenging times like this, but also give you that long-term growth through the cycle. And the outcome of that approach is a pretty high conviction and active portfolio that looks very different to the benchmark, as you'll see when I talk a little bit later about how we're positioned. We have I say it's long-term quality, so it's a buy and hold approach. So turnover is relatively low on the portfolio, and as a consequence, we view engagement with our companies as a sort of key part of the process to ensure that quality is maintained. And this is the approach that's been applied consistently for the 30+ year history of the trust. So that's the kind of overview. I've given you here a few of the sort of stats on the portfolio. I won't go through them all, but just to highlight a few that would kind of demonstrate the quality of the underlying portfolio. So on the right-hand table, you can see there's a return on equity there of the fund versus the broader investment universal benchmark. So New Dawn currently has a return on equity of 20%, and that's some way above the broader market. Strong balance sheets, I mentioned, are important to us. So it's almost a sort of net cash portfolio in aggregate. So just 8% net debt to equity ratios, again superior to the broader market. You get a mix of kind of income and growth with this. So the dividend yield on the underlying portfolio is about 2%, but you're also getting you've got the 3-year historic EPS growth figure here of 20%. So a sort of nice combination. And then I would just highlight the active share on this portfolio. As I said, it is an active high conviction portfolio, so 78% active share. And the last one, just on the bottom left of the slide here, just shows you that we do take advantage of the ability to leverage the portfolio, but in a sort of pretty conservative way. So it's about 8% geared at the moment.
In terms of, you talked about quality. In terms of like inflation, are they the sorts of companies that are better positioned to pass on price rises?
Very often they are, yeah. And we actually think about the inflation risk for the portfolio at the company level, and specifically target companies that do have pricing power. It's never clear cut. So often, these companies aren't entirely immune, and they are seeing, and there's numerous examples within the portfolio where we're seeing input cost pressure kind of eating into margins. But yeah, a lot of them do and are able to raise prices because they've got a dominant industry position and tend to be the price setter. So yes, that's an important sort of hedging mechanism against the inflationary pressure.
Okay.
Okay, so just some quick thoughts on the kind of market outlook at the moment, and I won't go into a lot of detail, and I'm happy to sort of take questions on any of these points. But clearly it's been a challenging time for Asian markets. They're down about 16% year to date. That's in US dollar terms, and that's principally been led by China. But it's not just China. There are multiple issues to think about, and I've put 4 on the slide here. So obviously the Russia-Ukraine conflict, inflation, as we just mentioned, slowing growth, and in addition to China, important to think about India as well. I think being the other big sort of engine of the region. I mean, very briefly, just on each of these 4, I think for the Russia-Ukraine conflict, I mean, yes, it's absolutely an issue for Asia, but the sort of direct impact is less severe than much of the rest of the world, certainly much less severe than the impact on the West. And that's really because trade ties are pretty minimal. There isn't the same sort of energy dependence, and the sort of banking linkages are fairly minor as well with Asia. There is the sort of geopolitical issues with China and India both abstaining on that UN vote on the conflict. So that does raise tensions yet further there, particularly with regard to China. But so far we've not seen any sort of ramifications from that. So I think really the sort of main issues that we're grappling with around the Ukraine war are second order impacts from slowing kind of global growth and therefore slowing exports from Asia, and higher commodity prices feeding through to inflation. I think on inflation, again, the picture is a bit better in this part of the world than it is certainly in the West, but even in much of the other emerging markets, it's still relatively benign here, and that's really because Asia had really quite low inflation going into this crisis, so it was in a very different place to many of those other parts of the world. And the benefit there is that it means that Asia's central banks can kind of raise rates relatively slowly without therefore compromising growth unduly. So whilst growth is going to slow, we don't think it's going to be sort of as abrupt as elsewhere. And on growth, again, we are still seeing growth in Asia. There's not the sort of same kind of recession risk that we're seeing or talking about elsewhere. That's in part helped by the fact that Asia was kind of behind the curve on the reopening post-pandemic. So Asia is now doing that, and that's providing a nice lift to a number of economies, not China, but the rest of the region. And so that's helping. And when you look at GDP forecasts for the region, we're still in the region of kind of 5% odd. So there is still growth, and there is still earnings growth, which is obviously what I'm particularly focused on as a stock picker. Probably see some downgrades there, but it started the year at sort of 10, 11, 12% type earnings growth, so a pretty healthy base. China, just briefly, I mean, a lot of aspects to the economy and market that we could talk about there, and there have been a number of headwinds, obviously, hence why the market's been underperforming as it has. Looking ahead, I think for me the key issue at this point is the zero COVID policy, and China sort of doubling down on this amid renewed outbreaks of Omicron, and their sort of desire and intention to contain this, rightly or wrongly. We can debate that, but that is clearly putting a brake on the economy, and as a result, we're pretty cautious on the near-term outlook there. But government's still targeting that 5.5% GDP growth, and is coming in with support in terms of stimulus and policy measures behind that. and inflation in China is not an issue. So so tough, but still growing. And finally, just to conclude on this, India, often gets overlooked, but it is one of the bigger economic engines, as I said. It is vulnerable to higher oil prices, so you need to sort of keep a watch on that. But so far, again, inflation's sort of under control. But the positive here, I think, is that this is an economy that is on a real sort of cyclical upturn at the moment. After several years, even pre-COVID, of very subdued growth, it's finally kind of coming together again, and we've seen some really encouraging activity, economic numbers, earnings growth come through in India, which is certainly positive for many of the companies that we hold through the trust.
So what's happened to your sort of weighting to India? Has that been going up or down?
Yeah, so if we look at the next slide, you've got the position.
Oh, here we go.
Now, I've rather unhelpfully, and apologies for this, I've sort of given you relative positions and not given you the absolute positions. India. Actually, if you were to look at the fact sheet, the absolute positions are there as well. But India is about 15% of the portfolio at the moment, so it's one of the larger positions. We inched it up a little bit, so it is, as I say, one of the larger positions. It's an overweight position, as you can see here, relative to the broader market. And the only thing that's sort of just holding us back a bit, obviously, there's this oil price question and what that means for the currency and inflation, but valuations. It's a perennially expensive market, but we've seen a kind of re-rating in valuations above even historical levels for India, and so just that's the sort of main hurdle, I think, for India.
Is all of the Indian weighting through that SICAV, the open-ended fund?
It's all indirect, so that's the bulk of it. We have a small holding in the New India, Aberdeen New India Investment Trust as well.
Okay.
But it's all indirect. Yeah, we don't at this point have any direct India exposure.
Okay, so that gives you sort of a broader base portfolio than you would have if you did direct investments. Is that the point?
That's right. Yeah. So those funds have approximately 35 holdings within them, and they span large to small cap holdings in India across all the sort of key sectors. So it is a nice diversified exposure that you're getting there.
I know Matt here wrote a big thing about India last week, so I'm guessing this is what spurred this. But do you actually think that India's kind of stance on Russia is hurting it in terms of things like FDI now?
I don't see too much evidence of that at this point. And we've seen, from a kind of diplomatic standpoint, all sorts of global leaders flying into India and trying to sort of shore up support, and part of that's FDI related. So I don't see it yet, but certainly it doesn't help. India's never been the easiest place for foreign investment from a sort of policy and regulatory standpoint and protectionist standpoint, and I guess this just adds another layer to that companies need to navigate through. But the private equity market in India has been incredibly buoyant, and that's what was driving a lot of the IPO activity last year, and some of it's continuing this year as well. No, I think it's reasonably okay still. Okay.
And then another question here is you got the prefs in Samsung Electronics. Is that something that you often do? Is go for the preference shares in Korea rather than the common stock?
Yeah, I mean it's a valuation call really. So the prefs trade at a sort of cheaper price, cheaper multiple. but we feel still give us sufficient protections as a minority investor. So we're happy to hold them. And that's really the rationale there.
Okay, cool. Just on China, can you see them walking away from the zero COVID policy at some point? Or are we sort of stuck with the endless kind of waves and lockdowns for the foreseeable future?
There's a couple of different parts to this. I think they're in a genuinely tricky position in as much as the level of immunity across the population is, nowhere near as high as it is in the West, for example. Partly because there's just been this effort. It's partly a product of the zero COVID policy that fewer people have got COVID, and therefore sort of naturally become immunized that way or inoculated that way, and partly because the uptake of vaccinations hasn't been great, particularly in the sort of elderly population, which is an issue clearly because that's obviously the most vulnerable part of the population, and partly because the Chinese vaccines themselves seemingly are less effective than the sort of the likes of Pfizer and Moderna and so on. So I think they've got to sort of tread carefully there in terms of reopening, but whether that kind of necessitates a zero COVID policy, I suspect not, but that's the path they're taking. The other bit is the sort of politics of this and the fact that President Xi is sort of tied his credibility to this at a time when he's seeking, I was going to say re-election, but it's just sort of a third term, let's say, as president. So I don't think we're going to see that kind of shift. I mean, obviously he's got an eye on maintaining economic stability and growth as well. But with the party congress not due until sort of October, November time, I suspect this is going to stay in place through until then at the earliest. There's also, there's a lot of work going on into local domestically manufactured mRNA vaccines in China. But it's still got some way to go. I think there's only one that's in sort of phase 3 trial stage at the moment. So that's going to just take some time. There is this option to import foreign vaccines, of course, but that's politically sensitive. So I think what we're going to see, yes, unfortunately, is sporadic kind of outbreaks again and lockdowns. I think, and my expectation, having been talking to companies and management teams in China in these last few weeks, is that these will be sort of shorter in nature and less draconian, so more localized lockdowns, and that they may be 1 to 2 weeks, and then and on a sort of smaller areas, so therefore less disruptive, but still, not ideal.
And then the other thing I suppose we should talk about with China is the sort of common prosperity thing and the clampdown that they had on some of the internet stocks. So what did you do with the holding of Tencent through all of that? Was it something that you topped up when it fell, or are you holding all the way through?
So we've held it. We've continued to hold a meaningful position. You can see here on the slide, it's still a top 5 holding. Just over 4% in the portfolio. We actually reduced it. It was a significantly larger position, last year, for example. So we've sort of been pretty cautious on it. I think from a quality standpoint, it is it's a great business, and I think there is still a very compelling, long-term growth story for Tencent. But it's just been clouded over the last couple of years by this regulatory sort of intervention and desire by China to sort of clean the sector up and level the playing field from a competitive standpoint. Some of which is quite right, and we're seeing it elsewhere. In the US and Europe as well. So just pulled it back a bit. I think we're sort of through the worst of it, is my sense. So we're I think we've hit the trough, and it's sort of gradually becoming easier and clearer, but we're not quite through the end of it yet, and in a position to sort of really have the conviction to start sort of building the position up in a meaningful sense.
Okay. This question here: do you actually have quite a big position in sort of semiconductors? I know you've got TSMC there, but is that true?
Yes. So if you look at you can see information technology is the biggest single overweight, and it's in absolute terms about 20, or so call it 25% of the portfolio-ish. TSMC, or Taiwan Semiconductor, our single largest holding. Samsung Electronics, part of which is semiconductor related as well as the next largest holding. We've got another, actually it's a Dutch listed company, ASML, but the reason we hold it is because it generates the vast majority of its revenues from Asia, so we feel it sort of qualifies as an Asia stock. So yes, and that's been, that was a big driver of performance for the trust last year. It did very well. We've seen excellent growth coming from these companies, really across the board. This year, it's been more challenging, not because the sort of fundamentals have changed, and in fact, they're still announcing or reporting, really strong earnings numbers and revenue growth. So the sort of very near term is still very positive. The issue is also more market sentiment and concerns around an impending recession, and what that's going to mean for the end demand of consumer electronics, smartphones, and the likes, of which many of these chips sort of find their way into ultimately. So we have pulled that back a bit. So we've taken a little bit of money off both, across the sector broadly, just in recognition of some of that kind of concern. But I think on a 3-year view, these stocks are as attractive and as compelling as ever.
You've got an overweight to materials. I know that, I suppose part of that is BHP. Can you sort of talk us through the thinking on that, please? Yeah.
So you're right. There's all sorts of things that go into materials. Actually, it's a sort of bit of a catch-all sector. So BHP is you can see the 6th largest position in the portfolio at just over 3%. That's a sort of core holding. We also have a smaller position in Rio Tinto. So in aggregate, that's sort of 4 or 5% of the portfolio. We've added another mining stock in the last few quarters in Australia as well, which slightly different to the sort of Rio and BHP. It's a copper miner, so it's a kind of play on that structural demand growth for copper that's coming from the kind of the green economy. So the mining stocks in there, and obviously those have been doing very well lately and become extremely cash generative. I mean, they were always cash generative, but become even more so and paying out very attractive returns as a consequence. But then in materials, we've also got some cement exposure. So this is partly through the India fund and partly in Thailand. And this is the simple sort of story of the infrastructure build out that is still, a structural growth story in Asia, particularly in developing Asia. So there's that part of the sector. And then the final bit is around materials that feed into the sort of electric vehicle story. So we have one electric vehicle battery maker, and we have one Chinese stock that makes a component that goes into electric vehicle batteries. Those would all come under materials, and those have been obviously seeing very, very robust growth given the rapid acceleration in electric vehicle penetration in Asia, and in particular in China.
You've got a holding in Sri Lanka there, or which obviously that's been hit very hard by what's going on with kind of oil prices and things. Is that something you're hanging on to?
Yeah, it's just one stock, and you're right. Obviously, the macro outlook for Sri Lanka is challenging, to say the least, defaulting on its debt and so on. So yeah, very, very difficult, both from an economic and political standpoint. We are holding on to it. It's obviously going to have a sort of challenging time near term as the economy slows down, but this is a sort of conglomerate. It's called John Keel's,
okay.
That spans multiple aspects of the Sri Lankan economy, from kind of ports through to hotels through to supermarkets. So we think it's well positioned to weather this, and will come out the other side in good shape.
Okay, so you're hanging on to that, and not adding to it. Yeah?
Not adding to it, but just keeping the small position that we have.
Okay, and then Vietnam is another one, because we've noticed that they used to have the sort of zero COVID policy, but have abandoned it and then gone on to much greater things. What do you hold in Vietnam?
Yeah, so we've got 3 stocks there. And they're all, well, 2 of them are sort of consumer related, I suppose. Vina Milk, which is the one of the sort of it's the dominant dairy company in Vietnam, with about 60% market share. So really, really strong position, and is really just a play on rising wealth levels and the emerging middle class in Vietnam, and increasing consumption of dairy and everything from sort of milk to yogurt and ice cream. So that's a very clear sort of long-term compounder that we've had in the portfolio for some time. And then we've added two other stocks a bit more recently. One, and the other consumer stock, is a company called Mobile World. It's a retailer. It started out as a mobile phone sort of retailer, so a bit like kind of Carphone Warehouse in the UK, I guess, and did that extremely successfully, became the dominant player, and has then diversified into sort of consumer electronics, and now into grocery as well, with sort of mini marts, and has a pharmacy chain. So it's really sort of run by this very capable, very impressive local entrepreneur who's a sort of true-blooded retailer, and is kind of making his mark in many segments there, and driving very strong growth. And the third one is a stock called FPT, which is primarily an IT services company, building on the sort of engineering talent within Vietnam, but it also has a sort of telco business there, and that's been really, really successful in generating business, not just within Vietnam, but also in many markets overseas as well.
Okay. We should probably move on, have a look at this. So are there any things, what haven't we picked up on, talking in terms of your investment themes, looking at this?
Yeah, I mean, I think we've covered a few of them already. So, I mean, tech enablers is the sort of semiconductor story. So the building blocks of the sort of technology revolution that continues. I mentioned electric vehicles, but I guess within going green, we've got some renewable energy stocks in there as well. So sort of solar power, component manufacturers, and these are Chinese companies, but they are already global leaders in terms of market share, and benefiting from really strong growth as China kind of continues to shift in its environmental policy towards greener energy, as with the rest of the world. Building Asia, we talked about with cement. Aspiration, I mean, I think this sort of cuts across a large part of the portfolio. I mean, we've got quite a big exposure to the sort of domestic consumption story in Asia, and a lot of this is you know, a play on, you know, structurally rising wealth levels, that emerging middle class, and therefore this kind of continued premiumization in products. So one example of that, it would be the holding in Budweiser Asia Pacific, which it's listed in Hong Kong, so it sort of gets captured under or classified under Hong Kong. But it's got two core businesses. One is China and the other is South Korea. And in both markets, they've done a phenomenal job in, you know, capturing that sort of premium segment, which is obviously the higher margin segment as well. And it's a segment that continues to sort of see structural growth. So they've done a great job kind of capturing that. And there are, you know, multiple examples in the portfolio. And then the only other bit would be health and wellness, where you know, Asia's kind of, I guess that's partly tied to this consumption story, in that as wealth levels rise, you tend to see more spending on, you know, healthcare. So that's part of it. But also, you know, Asia is home to some really interesting and extremely sort of competitive companies in the healthcare space that are in the sort of supply chain. So, you know, helping companies to design, develop, research and manufacture drugs, for example, or device companies, medical equipment companies. And these are, you know, Asia companies that are operating on the global playing field and you know, undercutting competition and taking market share and seeing good growth. So there's a reasonable kind of exposure in the portfolio to that theme as well.
So you're based in Singapore. Have you got people sort of going around the whole of the region, talking to these companies and meeting managers before you invest in them?
Yeah, so the sort of meeting with the companies is an absolute kind of core part of our investment process, and we're trying to, you know, obviously before investment, but also while we hold them, to keep on top of what's happening. We have offices across Asia, and fund managers and analysts based in, you know, 6 of the markets that New Dawn is investing in. So Singapore, but 5 others as well. About, you know, over 40 analysts in total. So it's it's a big kind of research engine that's you know, a real, you know, privilege for me really to be able to sort of draw upon in terms of then selecting the best quality stocks.
Then actually this question just popped up here. So to what extent is Asia a play on China? And to what, I suppose, you know, if the COVID thing holds it back, can Asia still thrive?
Yeah, so there is China is the dominant economy, obviously, in the region. I would say, so if China is struggling, yeah, we'll see a slowdown across Asia, without a doubt. Having said that, you know, ASEAN, yes, or Southeast Asia rather, is sort of linked closely to China, but there's also just a growth story in and of itself, you know, sort of 500 million type population or more, probably more actually than that now, in ASEAN alone, where wealth levels are rising and consumption is rising and so on. India's pretty separate from China. I mean, they're not the best of friends. So that's a sort of standalone story in many ways. South Korea has, again, linkages, but has got its own export story that's independent from China. So yeah, absolutely, China's important, but I think there's quite compelling kind of structural growth themes in other parts of Asia that are somewhat unlinked from the China story.
Okay. China was sort of not moving in tandem with the rest of us in terms of when it was stimulating and when it was growing and when it was drinking. And so as it emerges from COVID, what do you think the sort of picture is going to be like in terms of its finances and the economy?
I think there's going to be a very dramatic kind of rebound in China when sort of zero COVID finally gets removed and the economy and sort of mobility normalizes, and when the borders reopen. I think it's going to be very, very dramatic and very pronounced, and quite exciting. I think the state of the economy, I mean, the issue and the big sort of question mark is around the property sector, which dominates the Chinese economy and has been at the sort of forefront of the common prosperity agenda, with the Communist Party sort of focused on, removing the speculative element within property in China, sort of idea that properties for living in, not investing in, and because it's so sort of important to the economy, a lot will depend on that and how that sort of emerges from this. It's obviously in a pretty precarious state, and we've seen the headlines on some of the big developers that have been over leveraged and the difficulties there. So we're not out of the woods on that yet, but I think there's enough pent up demand for property in China, genuine demand, not speculative demand, and enough awareness amongst the policymakers to sort of navigate their way through this. So I'm not unduly concerned at this point by that, and I think China will be well positioned to rebound sharply when conditions normalise on the COVID front.
Cool. Okay, thank you. We've got some performance numbers here. Do you want to sort of talk us through how things have been moving? I suppose especially this year, given what's going on over here in the UK and US and.
Yeah. So I think, well, I mean, last year was a good year for the trust. I mean, in absolute terms, not that exciting. I think we did sort of 2-3% type performance, but it was ahead of the broader market, so outperformed there. A lot of that thanks to being underweight China, obviously, with China sort of having troubles last year and being underweight the internet names. In particular, albeit we had that 10% holding as we've talked about, but didn't hold a lot of the other names. And as I said, tech did really well. The TSMCs and Samsungs, as I mentioned, had a great year last year. So last year was good. This year's been more challenging, and so we've given up a bit of that outperformance. These numbers are to the end of March. But broadly speaking, it's been a more challenging start, and you can see the first quarter there negative 5% in NAV terms, and underperforming the broader market a bit as well, which is, I suppose, to my mind, frustrating in as much as this is a quality portfolio, and I've shown you some of the metrics that demonstrate that fundamentally it's a quality portfolio, and a quality portfolio should hold up better in more challenging market conditions, and historically that has been the case for New Dawn. So if you think about where the alpha, if you like, has come over the years, a lot of it has come from holding up better and being more resilient in the more challenging periods. So I've been sort of looking and thinking about that a bit. The main issue, sort of twofold. One has been commodities. and the impact that that's had on the portfolio. So we don't have any exposure to the energy sector, for example. So with oil spiking, we've not taken advantage of that in the portfolio. I mean, that's been a conscious choice, and reflects the fact that we just struggle to find high quality stocks in the oil sector in Asia. You know, a lot of them are, you know, national oil companies, government owned, not very well run, not the best corporate governance in many cases as well. So we've sort of shied away from it, but that's cost us a little bit. We do have the Rios and the BHPs, but which have done well, but you know, being underweight Australia overall has cost the trust a bit of relative performance this year. Australia, obviously, you know, as an economy and a market being very much tied to the commodity story, so you know, doing very well. Plus the whole reopening of the Australian of Australia post COVID. So that's hurt us a bit. So there's been the sort of commodities impact, and then the other bit has been, as I mentioned earlier, the reversal in the tech sector, which, as you saw, is a big position in the trust, a big overweight relative to the market, and that's not because the fundamentals have deteriorated. You know, as I said, these companies are still generating really, really robust earnings numbers, but sentiment has wavered on this sort of perceived or, you know, recession risk. So the share prices have sold off a bit. So those have been the two sort of issues. Okay.
Well, we'll see how it goes as the rest of the year goes on. I mean, it's going to be interesting. I think it's the way these markets are. But good luck with it all. So I think we better wrap up there, unfortunately, because it's 12 o'clock. But thanks very much for your time this morning. I think it's been really interesting, and it's definitely useful to get somebody, some relatively local's perspective on what's going on. So thanks, James.
My pleasure.
And we will be back next week talking to Paul Bridge from Civitas. And then obviously we've got a week off for the Jubilee holiday. And then we'll be talking to Craig Martin about Vietnam, and Najmi Hattie will be back on doing sort of roundup of what happened in May. So look forward to seeing you next week, and thanks very much for tuning in today. Goodbye. It's still fucking